Hey everybody, this is David Skarica. So just doing another one of these videos here. I'm going to share the screen so we can start looking at some charts. I just did an interview, which I think is, I'm a little biased, an excellent interview with Mike Swanson. I'm kind of more macro type indicators, talking about like the big picture, not even indicators, just the national debt, what's going on with these interest rates right now, et cetera, and why I think it's really important that these rates are increasing. And I talk about actually a little bit about my past, actually how worrying about a debt crisis in the early 90s is kind of what got me interested in the markets and trading and gold and precious metals and et cetera. And I find it ironic that, back then the national debt in the US was about 3 to 4 trillion. And as a percentage of GDP, I think it was about 50 or 60%. And there was like a lot of Ross Perot ran on it. There were books like The Great Reckoning, like the one I showed on the interview with Mike, which I again have here, Bankruptcy 1995 on it. And now that the debt is, 30 trillion, if you include the 1.9 trillion that was just passed, 30 trillion, basically 8 times higher than it was back in the early 90s. And now no one cares. Yeah, I just find that now we're talking about, we're going to have more stimulus on top of that 1.9 trillion. I bet you'll have debates over universal basic income. We're going to be talking about green new deals, et cetera, et cetera. So those kind of things I find to be like a little bit ironic on top of everything else. With everything that's kind of gone on now with the markets, right? So, yeah, and just a couple of things before we start here. I always get a few comments from my subscribers. 3 things. Yeah, some people I never want to ask what I'm drinking. This is just coffee. Usually it's coffee, water, and if you see me do like a Friday evening or weekend, I love champagne, so I might be sipping on some champagne sometimes too, right? So that's usually what I'm drinking. The suits, I've had people reference to the Miami Vice thing. Actually, I love this one here. And this is like some of them are vintage. Like I got this, I think, off eBay or Etsy. And this is like from the 80s, right? And I'm a big Miami Vice fan. And living on this island is very casual. And this gives me a chance to kind of, I guess, play Mr. Dress Up and do the Don Johnson thing and wear my Miami Vice suits. Because when you go out here, usually you're just wearing shirts, T-shirts, and sandals. Like I probably wear shoes once every 3 or 4 months here. Like I'm either in bare feet at home or in sandals, just the island kind of lifestyle, right? And we have a cold front going out today. This darker suit jacket, most of mine are linen. This is heavier. Yeah, I think it's cotton. So it's a little, it's one of the few days here when cold fronts come through, I can wear a heavier suit jacket like this. So anyhow, that's it. And the third is my hair. I know I've had a few comments about how long my hair is. It's really long, like especially I have in a ponytail right now. When it's not in the ponytail, it's like like a woman's hair. I can feel it touching my back. And I made because I don't like all the rules and regulations, so I made kind of a promise to myself that I would not get my hair cut until coronavirus or COVID was finished. And I may have to backtrack on that because it's taking forever. I haven't cut my hair in over a year, other than trimming the back and stuff like that, and it's getting to be really, really long. And I gotta say to you females, I don't know how you do it because I gotta brush this thing all the time. Gotta make sure I put conditioner in it, not just throw some shampoo in it. It gets in knots. It's a real pain in the ass to have long hair. It takes way longer to wash. So I kind of enjoy it in some ways. It's cool, and I'm 43, so I'm at the age. At least I can still grow my hair long, and I have a little bit of gray, but nothing over the top. But it's also becoming a little too much at times. So, especially it's still cool here. Like I said, we have a cold front. It's mid-March, but we're going to be getting into, once we get into May, April, it starts getting humid here, and it gets a little difficult. to have the long hair like that. So, okay. So anyhow, so yeah, we've seen this. And what's interesting about this whole secular, bull market and bonds, this goes back 20 years. This only goes back to 2000. But even here in 2000, notice like the slow uptrend that happened after from '02 to '03. Notice, there was some little spikes here and there, but this is a much bigger spike, especially the logarithmic scale really shows it. Now, I know it's coming from a very low level, but I don't think we've ever seen a spike like this where, like, when rates doubled from the 2016 lows, it took basically 2 years. This happened in 6 months where we've tripled off the lows. And again, like, I think the fact that I know the market's up today, but the way the market is kind of acting, it's almost kind of saying, like, we can see that Nasdaq's down 77. It's almost kind of saying that the fact that the market's not just up and away, like, that 2016 again to 2018 level. If we go look at the S&P, but we'll in a second here, the S&P went straight up for most of that, right until the end. You see the 2016 here. Yeah, notice until that fourth quarter 2018, the S&P soared. And same thing when rates, we just talked about '02, '03. Actually, there's a semiconductor in S&P, but you can see the semiconductor soared. The S&P here, you can see off those lows, basically soared other than the fourth quarter of 2018. And when the rates again went up from like '02, '03 to '07, the market like rallied. Well, now we're kind of seeing this different mode where the market is kind of stalled out with these rates going higher. So, and I'm trying to really short, these kind of growth things. And there's numerous reasons why. Like, I don't want to talk about shorting too much in this one. I want to talk actually more about the gold and gold stocks and maybe like what you should be buying, etc. So I think now with gold under 1,600, the gold stocks are actually showing relative strength opposed to gold. I think now is the time to start to look at it. So anyhow, you can see that Nasdaq is actually down. And remember, a lot of these stocks isn't just, higher rates for growth stocks. No, it's like, again, like I'll look at one of the shorts here. We have Etsy, which is up a tiny bit here, but like these things have gone up so much. We'll get 5-year charts on these. You can see, this Etsy has gone from 10 to 200, and then from the bottom in last March, 30 to 200. It's just that these stocks have gone up so much and they benefited, their business benefited. Like I said, this perfect example is the suit, right? Now, I tend to order more online because I live in an island. We don't exactly have a lot of shops here. But let's say I was like in New York or Miami or Toronto or wherever I was, and I was like, well, I want to go find some of these old vintage, 80s Miami Vice suits. I'm going to go to a vintage store, and I'm sure I could find one and go in there and try them on and this kind of thing. But when you're stuck at home on quarantine, you're like, oh, this thing's on Etsy. This thing's on Etsy. It's on eBay. It's on Amazon. All of these sort of things, right? So I think that when you're looking at all this, it's like you just that's the benefit that these companies have kind of gotten. Actually, it just hit me to move my chair up. Yeah, it's a lot better. Have kind of gotten because of the coronavirus and this kind of move to buying things online, et cetera, et cetera. Let's see if this works a little. Yeah, it's gonna work. One second, give me a second here. Just gonna move my curtain open a little there. So yeah, get some nice light. As you can see, like half my face. But anyhow, yeah, that's the kind of thing that that we're kind of looking at here, right? In terms of the markets and and these things kind of going straight up, like Amazon. And again, you notice, like, a lot of these stocks have been moving up for years, but you really see the move, catapult after that loss. And a lot of the, stocks are having business. And it's not just tech stocks. It's Walmart. Go look at the chart of that. Yeah, like Walmart, boom. Look at that first initial rally. Now that, again, that's coming, that trade is coming out of it. And it just makes sense because they had all this increase in revenues and business because people sitting at home buying things online or having to go to the big shops, Walmart, Costco, et cetera. And then now it's like people, like, if things reopen, might go to the little boutique stores again if they're still open. A lot of them, unfortunately, have had to close, et cetera. And that's kind of going on here in terms of the markets and the whatnot, and these kind of trades. So it just makes sense that like this kind of influx of the business that these companies got because people are buying everything online is now coming out of it. And of course, one of the shorts we have, which I'm really happy with, and this is probably my largest of all the shorts I have, is ARK. And the reason I liked it and made it the largest is because this stock owns all those momentum companies that are overvalued, got the one-time growth in business due to COVID, and this has become kind of a fad. And again, notice like ARK had been slowly moving higher, from 2018 into 2019. But notice this acceleration that occurred right here after that low. And right now we're just back to the 200-day moving average. And of course, one reason is ARK's largest holding is Tesla. And you can see Tesla too. And when I look at these stocks, and when I really look, that's the log scale, and it still looks bad. But when we look at these stocks on a linear scale, ARK, and I'll put ARK back up in a second, Tesla, it really looks like a lot of these companies have started to break now, right? This is Richard Branson's space, stuff like that. That's a total parabolic blow off and crash. It just looks like these stocks are now broken and that they're not going to be like just coming back and going to new highs. So it does look like the bubble has kind of burst. And a similar kind of trade happened now, because now we're seeing the Dow holding up better. We're seeing oil and gas do better. These sectors do better. The financials are doing better, and you can see ARK looks broken there, right? It looks like, okay, now it's oversold. Maybe it will bounce back 130. That'll probably get a great entry again and then roll over again. But this happened in 2000 where the tech stocks kind of blew off, and then they rolled over in March, April. But the Dow was holding up better because there was a rotation in the quote unquote old economy stocks, right? So now we're seeing that now with things like the oil and gas stocks, JP Morgan, I'll put up Exxon, doing better, right? And you see Exxon actually almost went back to its April low last October, and now is totally broken out. A stock I talked about, which unfortunately I don't own any anymore. I made a quick, but this stock is doing fabulous. This is Athabasca, which went down into the teens. And then you can see, and actually this doesn't even do it justice, because when this thing started trading 10 years ago, it was $18 a share and it went to 10 cents. Now it's back to 60 cents. And these things are starting to come up, and it really looks like we're getting in a bull market for oil. Now, if there is some kind of short-term deflationary bust in the stock market, we could see oil pull back. But I think the bottom is in and we're going higher. And actually the oil production in the United States, has gone from 17 million barrels pre-COVID at its all-time peak to 11 million barrels. So down over 30%. So that is adding to the oil price because production is coming off the market, and globally we're seeing economies recover and demand return, et cetera, et cetera. And of course, like a lot of like the economies like in Taiwan and these places like this, these things weren't even, they only had, I think Taiwan only contracted by 1% last year, and a lot of them are already getting back to pre-COVID levels. So I'm going to say that I'm happy that like I'm short, the NASDAQ stocks. I'm in my own shorts. I'm short in my funds. I'm short the Russell 2000. I'm short, the NASDAQ 100. I'm short the stocks. And of course, I have these individual shorts. And of course, the one I really like is the XtgE, down a little bit today. But this is something you can just kind of average into here. And, if you really are a conservative trader, you could put a price stop loss at 25, which essentially like, is not even 4%, or it's like not even 3% from here. And then, just wait till it starts to bottom again. So, of course, there's another one. This is the Dave Portnoy's Buzz things, just traded a few days. I'm probably not going to short that, but I think that's just a sign of the mania that we are in. So anyhow, I just wanted to discuss that. So, okay, now let's go look at the gold and precious. Oh, the last thing I'll discuss too is, again, this LQD trade. We're seeing rates again up today. LQD smashed again today, down 0.5%. And that's a big move, man, for these bonds. And they're really rolling over very hard. That again, to me, this looks broken. This looks like we had this topping formation going back to the middle of next year. Now we're rolling over, and I don't know if we're going to do something like it did here. But look, I was short this via put options in 2018, and just this move from 110 to about 103, 104. So just a 6-7% move on the LQD. Was basically made my puts double and triple. Just a small move because there's not a lot of premium priced into these puts. So right now I own the January 127s, and they're doing really well. Let's go look at the option trade. And I want to see how they're doing myself after today's down move. Probably that last price is not focused in. So here it is here. Let's go look at the options. Oh, it's June, sorry, 22, January. Okay. 127s, up 18 cents, 470 to 510. I bought most of mine at 3 and I added on at 4. So my average price is probably like 330, 340. So I'm already up 50% on this trade. You see the implied volatility is only 12%. Like, here's a perfect example. Obviously I still own my Etsy puts, but Etsy, the puts here, I own the 150s. I want the January. I don't want to, come on, please don't do this. Here are the January 122s. The 150s are about $19. I think I bought two, one at 18, one at 13. So my average price is about 14. And you see applied volatility is 61%. So that just shows you how cheap those are. So I still really like, what I just do? I gotta move this down. I still really like the the LQD puts. I think this is just right. And now, if you want to buy a little more out of the money, because we were buying these in the low 130s when the LQD was low 130s. Now the LQD is it's 129. So if you want to buy the 125s and 120s, be my guest. But I really think that this is some kind of major top in the corporate bond market, just like I think it's a major bottom in yields. And you can see how well this thing was done. When it was launched at like $40 in 2002. So not only has this tripled in 20 years, but also on top of that, you've probably got an average yield of 5-6% a year on top of that. And if anyone knows a rule of 72, that means you've doubled your money. You've probably then made 7 or 8 times on your money on this thing, including the interest, just from bonds, which is like ridiculous, right? Since 2002. Anyhow, so now let's go look at gold. So the gold stocks today, the HUI you can see is down a little bit, but it's not really down that bad right now. You can see this, and actually note that since late February, the gold stocks have kind of been trending upward. And if we go look at the HUI, for example, let's actually get the GDX to gold ratio, because that will show, our GDX to GLD, because that will actually show today's action too. But you can see, yeah, that's usually a positive side. Now, you can see it happen in February, so just a small move like this, but I think it is positive. Doesn't mean it might not mean the end all be all, but I think the positive thing is that, yeah, they're down 1% today, but even though gold is kind of breaking down to a new low for this move, the stocks are not, and you can see we're oversold. I would like to see the RSI get into the 20s on this, but I think that if you do get a move down to 30 on this, and that happens, you're really going to want to look. So here are some of the stocks I like. I like African a lot. They just did a financing. Stock never even really moved during the last move, but it's beaten up. It probably won't move that much lower from here unless gold really were to fall out of bed. But, at 13, 14 cents, I think African is an excellent prospect down here. I actually just bought a little more around in that 13 to 14 range, averaging down. Eurosun, these are a couple Stan Barty deals. You can see that's gotten whacked here. It's right down now, back at its lows. If that were to fall into the 20s, I think that would be a great buy. Yeah, you can see it right here. They did, last year when the market crashed, it had this false breakdown into the teens. So, and you can see when it was in the mid 20s here, there was a big run in 2019. So yeah, and you can see here again in 2020, after that, when it went to late 20s, it had a big run. So yeah, this were to break here, and I don't know, fall into the mid to low 20s, I would definitely look at averaging some down here. The one that we just raised some money for, I think cat. I got to get a shorter term chart. I hate when stuff like that happens. So I have weird false print. But yeah, cat, it's really only started being a real company, or what the company it is today in terms of, here. So yeah, if cat, you can see it's getting oversold. I don't know if it would, that 6-7 cents area, I think is going to represent some very good support here as well. So I like that down here. And plus, this is not just a gold play. They have base metals, they have uranium, they have lithium exposure, et cetera, et cetera. So these are the kind of things I like. Delaney, actually, you know what? The one I really like, it's a new company that Mike and I just did a consulting contract with. A friend of mine named Jimmy Longshore runs it. This is Extra Gold. You can see it's actually held up pretty good. It's come down here recently. But this actually is cash flow positive, is profitable, has the same number of shares out now that it did 10 years ago, about 40 million. So they don't need to issue money because they're taking the alluvials, like the kind of high grade gold that's on top of the property, and they're mining it and selling that off, and then creating cash to pay all their expenses and to pay for the drilling. So and they're right next to Newmont in Ghana. So I really like Extra Gold here as well. So yeah, full disclosure is they're one of our consulting companies we consult with. So Mike and I have been paid by them, but I also buy these things myself, and I really like it. I've known Jimmy, the guy behind this, for nearly 15 years, and he's a great guy. He's a total character. Spends a lot of the time. He's got a house here on a little island called Rose Island. He basically lives in a little house and boats around when he's not in Ghana on the property. So, and yeah, I really like that as well. If you just wanted to also buy calls in GDX or GDXJ, that's probably becoming an interesting prospect now because you are oversold and whatnot. So I think, people ask, well, why is gold going down? They're printing all this money. They're running these huge deficits. I think there's two reasons. I think the backup in rates in the short term, especially with some people thinking, oh, rates are going up, the economy is good. And the normalization trade, we've seen the COVID cases. Let's go look at the COVID cases in the USA. Actually, that's a good website. This is a great website, by the way, for those of you interested. This is healthdata.org. And you're going to see these are projections. So this is the projection of where the cases are going. And you can see the worst case projection is starting in April. It would flatline for a few months and still move lower. So the best case scenario is that this thing is going to be almost non-existent by July. So there is this kind of belief that everything's normalizing, people are going to start going back out again, blah blah blah. But my opinion is that the damage has been done, and you're going to see a lot of the economy not come back, and also I think that kind of the straw that's going to break the camel's back or jump the shark or whatever you want to call it will be when they do the infrastructure and Green New Deal project in the summer, because I think that will be too much for the market to handle. So what I'm trying to show this for is this kind of the normalization. People are like, oh, this thing is going to, so these are the daily infections right here. So you can see here, the worst case scenario is that they'll go up a little bit and then flatline basically. And the best case scenario is that they're almost going to be nothing by July. So, and that's the official projection right there. Right. And this thing has been very accurate because when I looked at this back in the fall, it predicted that in the winter you would see a big spike in America, and then in the Bahamas where I live, it predicted that actually, interesting enough, it predicted that there wouldn't be a spike here, where everyone else had the second spike, and then it would just kind of flatline at almost zero, and that's exactly what's happened here. So you can see here, in the Bahamas, they're just that's percent change, but there's the daily infections. You can see that we're kind of just flatlining now. Because they are so low. Like we're getting 10 to 15 cases a day here, and most of them are in Nassau. So this, what I'm trying to show though, this thing was very, very accurate. That it actually predicted the Bahamas wouldn't get the secondary spike later in the year like everyone else did, and then now continue to trend lower like everything else as well. So I think that's kind of the next thing too. So you're gonna have to be patient. And another thing too about gold, there's actually another thing with gold here too, is when we go kind of look at these, and you see gold is getting very oversold. It's getting even more oversold today. Let's go look at the GLD. And I just want to show you like a longer term chart. It looks to me like with gold that, now we're even lower today, that you look at the GLD bottoming at roughly 100, in late 2015, or 110 in 2018. So if you take 100 to 195, that's about 95 points. You're talking 47 points, 50 points is the 50% retracement. So maybe 145. If you're taking 110 roughly to 195, and that's 85 points, you're talking low 150s, which is another 5 points from here, basically 1,600. So that's what we're kind of looking at here, is that 50, that's the 50% kind of retracement. And you can see just how oversold we are now. Like the last time we got this oversold, actually, we didn't get this oversold at the spike bottom last year, was that 28 thing. And you can see it bottomed there. And actually, here's what's interesting about that, which I'm going to talk about in a second. Gold GLD bottomed, and gold bottomed in the fall of 2018, ahead of the market topping, right? The market still continued higher. Even though the market's come off, the S&P is still near its highs. So gold was kind of basically bottoming. And then when the market moved lower in the fourth quarter of 2018, gold rallied. Same thing happens here. The market didn't bottom until January of 2016, but gold bottomed before the market bottomed or fell hard on the retest there of the August lows, and then began to move higher before the market, or while the market had that last decline. So that could be a sign here. If we start to show some bottoming signs in GLD, in gold, and some topping signs in kind of the market, that could be a sign that the market is going to top and then kind of roll over here, right? So that's another thing kind of as well. And I think the one issue the market's going to run into, I showed you how the Nasdaq's lagging, is you go look at these financials. Sure, they could go a little higher. There's JP Morgan, there's Goldman Sachs, but now they've had such huge rallies. It's like they're probably very late in the rallies, right now. And they're going up because they do arbitrage on like rates. Look at straight, basically since rates going straight up, notice these have gone straight up. So again, how much, we just saw what ARK did. Like how much more upside is there going to be in JP Morgan, in Goldman Sachs, et cetera, kind of going forward here. So, and so we could continue to kind of, do this churning for a while. That's why I always buy my puts in January. The only puts I bought that were shorter in ARK were the 80s. And, I'm pretty happy with my puts. Like, okay, XT's sitting there flat today. ARK is down. The LQD is down. Those are my two largest positions. Microsoft, which I got because the premiums are lower. Microsoft's down today, So it's like I'm pretty happy, even though the Dow is up 400 points today. And with the gold stocks, I was very lucky. I know some of you bought the 25-cent financing in Norseman. I was in on the 5-cent financing last year. Now, look, at a lot of you may say, oh, that's unfair. You're getting in so cheap. When I buy these things, they get offered to me. Half the time, I don't even know what the hell the company is or what it's doing. just like, oh, it's a 5-cent financing they're offering to me, I'll do it. And then a lot of them just sit there and do nothing. I don't tell you about the ones that do nothing. Yeah. And then a lot of them, go up like this, not a lot of them, but some of them go up like this. So I really lucked out because one reason my own portfolio isn't really down, it's only a few percent from its highs, is because this stock became one of my largest holdings. And I have taken some off the table here. I really like it. They're going to have a nice silver property down in Chile. I think it's a great company. But, when some stock becomes 20% of your portfolio, you got to kind of, take some money off the table. That's only prudent. And for those of you in some of our non-gold deals, let's quickly talk about them. Sorry. Sometimes some of these are, so this is Plymouth Rock. Looks like it could be bottoming here. I don't know if it will be a failed rally. So what happened with this is many of you did like, I think a 25 or 30 cent financing last year. It's now free trading. So you've done well on that. You've basically tripled your money, plus your warrant is doubled. This is why I just don't want to do gold and precious metals, because they've corrected. But, something like this is a drone company. I really like the company. It's got a great drone technology. They make them all in the UK too. And having drones not made in China is going to be a big deal going forward. So, what I did is right before the stock took off, I was offered a 20-cent financing with a 25-cent warrant, when the stock was kind of in the low mid 20s. I was like the last guy to get into it. That's why I couldn't offer to you. So I have that, but I am, this closed sometime in January. So I probably have another 2 months on the hold. So whatever happens, happens. And then the other one, and I actually recommended this. Remember, in one of my podcasts, I said, look, just in case the market does keep, going higher. This is a fintech company called Cana One, down a few pennies today. Pretty light volume today, but you can see that same thing. I bought a 10-cent financing right before the stock moved, and now it's 69 cents. Similar to ARC as well, though. I got another couple months on the hold. But I also said at 45 cents, like a few weeks ago, that this would be worth buying as a company that, hey, if the bubble continues and the market continues going higher, they're in fintech, it's a growth industry, et cetera, et cetera. And I don't know if any of you bought this at 45 cents, but you would be up, about 60 to 70% if you had bought this between 40 and 45 cents, which you had about a month or so to do so in February, or besides mid-February. So anyhow, I don't know if you want to really chase it up here, but this is the kind of thing I do now. I've got the shorts, I've got the hedges, I've got the gold stocks. I'll buy a couple of things like this just in case the market continues strong. And, it's like, there's that old saying, you don't try to be a hero. And that's exactly what I'm doing. I'm not trying to be, I told you my hair was long. I'm not trying to be a hero. And, I'm just like, well, if the bubble continues, my ARC and my Cana One. I know some of you also bought MVMD, which I think they did a 40-cent financing. The stock is $1.32 now. Was over $2 at some point. So anyhow, it's like those will continue. If everything goes to hell in a handbasket, gold will probably reverse at some point. And then it looks like, hey, let's say they are right. The economy is getting better. Rates are going higher because of that. Or LQD trade is still going to work out. Now, in a crash, LQD trade is really going to work out. But if rates just kind of churn higher, and say the 10-year bond slowly goes to 170, 180, the LQD trade is still going to work, So anyhow, I guess I'll just leave it at that. I think we talked about enough today. So I hope you enjoyed that. If you want to see that kind of macro picture on Mike Swanton and I talking about the debt situation, etc. You might watch that video, which is I'm going to put up on my website. And this was kind of going over some of our trades and the whatnot. So I think this was enough. And I'm going to get out of the suit jacket now because it's cool today, but who the hell wants to be wearing a suit jacket in Eleuthera in the middle of the day for longer than, say, a half an hour or an hour?